Hello everyone, my name is Clément Gignac. So over the next 5-6 minutes, I will try to summarize the webinar that we have just recorded for the benefit of our financial advisor. We talk about the big picture in the financial market and the investment strategies. So let's start with the title that we have mentioned, Trade Tension and Volatility Are We Heading to a Recession? I will start with my answer. I think that it's an alternative scenario. We give 25-30% probability that we could heading to a recession. Make no mistake, we have a deceleration of the economy. We see that overseas, in Germany particularly, but we have in US as well. So the ISM has decelerated a lot. Even the non-farm payroll figure the last month was much weaker than expected. But before predict a recession, I think that keep in mind that business cycle never die of old age. Of course, we have this trade tension between China and US. So we explain in the webinar, and you have a PDF attached to this video, that you can notice that, yes, we have a negative impact of the tariff that Mr. Trump has put in place, but so far it's not enough to create a recession. We estimate that the current tariff with China will have an impact of 0.2, 0.3 negative on US GDP. So let's say that US GDP, US economy will grow closer to 2 rather than 2.5 and 3. And on China, the impact could be 0.8% of GDP for the current tariff. So the Chinese economy, will grow probably around 5.8% rather than 6.5. But we will need much more, or we have to see, I will say, much more tariff on China or maybe on Japan and Germany before predicting a recession. So we are ready to change our mind to increase the probability of recession, but right now, for the current situation, is not enough to create a recession. Of course, you have the Osaka G20 meeting at the end of June, so we will keep you updated on that one. If we have additional tariff, we will change maybe our mind, or we could increase our probability of recession. But keep in mind that on the other side, you have a positive development. You have this Federal Reserve who have decided to change really their tone. They have not changed yet their monetary policy, but they no longer talk about interest rate increase. As a matter of fact, financial market investors now expect that the next move will be a rate cut, could be as soon as this summer. In addition, China as well react with stimulus. So to offset this headwind from the tariff, they have decided to put in place stimulus on the tax cut and spending as well. Recently, they have authorized the local authorities to issue bonds to finance infrastructure program. So as you can notice, before predict a recession, you have to analyze all the factors, the tailwind and the headwind, before predicting a recession. In Canada, in the context of absence of recession in the US, you start to see some reacceleration in the economy. In the Q2, we think that the economy will grow at 2.5%. We have a very strong labor market with the unemployment rate who has dropped to a historical low. So this is very interesting. So I think we're heading to a divergence of monetary policy between the Bank of Canada and the Fed. So make no mistake, if the Fed cut interest rate, the Bank of Canada will not increase interest rate, but probably the Bank of Canada will not match the Fed move. In addition, if we are right with our optimism that the Fed, in fact, will have no necessity to cut rates because you're not heading to recession, don't be surprised if the Bank of Canada, in fact, continue to normalize interest rate with some rate hike. So we will see, as whatever the scenario, rate cut or not, we think that the Bank of Canada will not match the Fed movement, and in fact, you will have a narrowing spread, and the Canadian dollar, who currently trade around 75 cents, will probably be closer to 78, 80 cents by year-end or next year, because the fundamentals of Canadian economy are much better than US. In terms of a financial market, so far so good. If you check the asset classes, bonds has performed very well. So Canadian bonds 5% year to date, the high yield close to 10%. Stock market, whatever is US and Canada, plus 13, 16. What is our outlook on the asset mix? Keep in mind that, yes, a reduction of interest rate by the Fed will be very well received by the market. But on the other end, If they reduce interest rate, it's because you have probably some headwind against earnings. So in such circumstances, it's a tug of war, if you want, between rate cuts possible and deceleration of earnings. In our case, we expect, in fact, an earnings recession in U.S. Why? Because a lot of U.S. companies have overseas, sales overseas. The sales overseas represent now 45% of the total sales for the S&P 500. So in such circumstances, no GDP recession in U.S., but possible earnings recession. So that's the reason we think that the market will remain volatile, particularly since we don't know exactly what Mr. Trump will do, but it will be a buying opportunity if you see some weakness for any people who have a more 2-3 years time horizon. In any case, we invite you to consult your financial advisor that will help you. On that note, I wish you a good day and have a nice summer.